Hi, my name is Daniel Gonzalez, and today I will be presenting on AT&T's cost of capital. For this presentation, all numbers will be in millions. Question A. How much interest-bearing short-term debt did AT&T have at the end of 2014, and what was the average cost of this debt? AT&T's short-term debt was $6,056, and the average interest rate paid on this was 4.4%. The number is calculated by dividing the interest expense into the total amount of debt. Question B. What was AT&T's capital structure at the end of 2014, and what portion of AT&T's capital structure was short-term debt, long-term debt, and equity? Short-term debt was $6,056, which makes up 7.38% of the total debt, and their long-term debt makes up the other 92.62% with $76,011 of debt. When you look at the capital structure, you have to also consider equity, and AT&T has a total shareholders' equity of $86,370. Their capital structure consists of 3.6% short-term debt, 45.13% long-term debt, and 51.2% of equity. Question C asks to recalculate AT&T's capital structure using only long-term debt and common equity. Long-term debt and common equity combined are $162,381, 46.81% of which is long-term debt, and the other 53.19% is common equity. Question D. Assume AT&T wants to issue fixed-rate 10-year bonds. If their investment bankers tell the firm that they can do so at a spread of 1.5% greater than the equivalent maturity Treasury security, what would be AT&T's before-tax cost of this long-term debt? The rate of a 10-year bond is 2%, which is found on Bloomberg.com. When you add the premium spread of 1.5%, you get a before-tax cost of 3.5%. Question E. Review AT&T's 2014 notes of consolidated financial statements. Examine the note on income taxes. Use the average tax rate for 2014 listed in the financial notes as an estimate of AT&T's relevant marginal tax rate to calculate the after-tax cost of short-term debt and long-term debt. The formula for the after-tax cost of debt is the cost of debt multiplied by 1 minus the tax rate. AT&T's pre-tax cost of short-term debt was 4.4%. Their tax rate is 34.6%. Calculating their after-tax cost of debt comes out to 2.88% for the short-term debt. Their pre-tax cost of long-term debt was 3.5%, and their after-tax cost of long-term debt comes out to 2.29%. Question F asks to use the capital asset pricing model to calculate the expected rate of return for AT&T. The capital asset pricing model formula is the risk-free rate plus beta multiplied by the market risk premium. In this problem, the market risk premium is given at 7%. Risk-free rate is 3%, and beta for AT&T is 0.33. After calculating the formula, the expected rate of return for AT&T is 4.31%.